Hello and welcome back to the channel, your go-to source for demystifying how to borrow stocks and potential short squeeze setups. Today, we're diving deep into a fascinating name that's recently landed on our screener with some eye-popping metrics: G Education Technology Group Company Limited, ticker symbol GZ. Before we jump in, please remember this important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's kick things off with G Education Technology Group Company Limited, or GZ. This company operates in the technology/information technology services sector, specifically focusing on developing and providing educational content products and IT services to higher education institutions in the People's Republic of China. It's a microcap stock, currently sporting a market capitalization of just $6.06 million. What's caught our attention isn't just its business, but some incredibly compelling data points that suggest it's becoming extremely hard to borrow for short sellers. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? When you want to short a stock, you essentially borrow shares from a broker and sell them, hoping to buy them back later at a lower price to return to the lender. But there's a cost to this. This is the cost to borrow, or CTB fee, an annualized interest rate paid to the lender of the shares. When a stock is hard to borrow, it means there's high demand from short sellers and limited supply of shares available to lend out. This scarcity drives the CTB fees sky high, sometimes well over 100% annually, as we're seeing with GZ. Think of it like renting a rare item: the fewer available, the higher the price you pay. Why this stock is hard to borrow right now? Now, let's talk about G Education Technology Group Company Limited specifically. A hard-to-borrow screener flagged GZ with an astronomical cost to borrow fee of 926.9% annualized. Highlight on screen: 926.9% CTB. Yes, you heard that right, almost 927%. This isn't a typo, it indicates extreme scarcity and demand from short sellers. What's more, this isn't a static situation. GZ CTB momentum has surged by an incredible 139 percentage points over just the last 5 trading days. This rapid increase shows that the cost to short GZ is not only high but accelerating. And here's another critical data point: there are currently only 1,000 shares available to borrow. That's an incredibly low number, making GZ one of the most difficult stocks to short right now. While its estimated float is currently unknown, the combination of a near 927% CTB, a dramatic surge in fees, and a mere 1,000 shares available to borrow suggests a tightly constrained supply environment. Our internal composite squeeze score for GZ sits at 49.1 out of 100, which is notable given the challenges of shorting this name. Squeeze mechanics explained. Why does this matter for a potential short squeeze? Imagine you're a short seller, and you're paying nearly 927% per year just to maintain your position on GZ. If the stock price starts to rise, your losses increase and your borrowing costs are skyrocketing. This creates immense pressure. If the stock continues to climb, short sellers might be forced to cover their positions to stop their losses and mitigate those crippling borrow fees. To cover, they have to buy back shares in the open market. This buying pressure, especially for many short sellers simultaneously, can rapidly drive the price even higher, trapping more shorts and creating a feedback loop known as a short squeeze. It's important to remember, though, that a high CTB does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis, and they are willing to pay these exorbitant fees to stay short. Dilution risk check. When we look at short squeeze setups, dilution risk is a critical factor. Dilution occurs when a company issues new shares, which increases the total share count and can depress the stock price. This can completely negate a short squeeze thesis, even if borrow fees are high, because new shares provide an easy supply for shorts to cover or for new shorts to enter. For G Education Technology Group Company Limited, we have good news on this front. Our tech shows no recent dilutive SEC filings like SMINUS1, SMINUS3, or 424B found in the last 90 days. This means, at least for now, there isn't an obvious source of new shares flooding the market to offset a potential squeeze. Recent reverse split watch. Now let's address a very recent and important event for GZ, a reverse stock split. G Education Technology Group Company Limited executed a 1/4-30 reverse stock split on July 6, which was just 11 days ago. A reverse split reduces the number of outstanding shares and, in theory, proportionally increases the share price. For instance, if you had 30 shares at $1 each, after a 1/4-30 split, you'd have one share at $30. This process effectively reduces the float, which can sometimes amplify volatility. Historically, many microcap stocks, especially after significant reverse splits, tend to see renewed volatility or even a price pop within about a month after the split. This isn't a guarantee, of course, but it's a pattern that has been observed in some names, and it's certainly something to keep in mind when evaluating JIZI right now. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what does all this mean for JIZI, especially with its recent price action? Over the last 5 days, JIZI is down 30.38%, and over the last 30 days, it has fallen 70.53%. Even today, it's down 3.51%. Joe Price chart. Despite this recent downward trend, the extreme CTB and shrinking borrowable shares are key indicators. Its current volume of 199,205 shares today is right around its 30-day average volume of 189,928 shares, giving it a relative volume of 1.0x average. What we'd want to watch for are sustained increases in buying volume, especially on green days, coupled with continued high CTB and diminishing shares available to borrow. If the price starts to push higher and hold, the pressure on shorts paying nearly 927% could become immense. G Education Technology Group Company Limited JIZI presents a fascinating case study in the hard-to-borrow landscape right now. With an annualized cost-to-borrow fee of 926.9%, significant CTB momentum, and only 1,000 shares currently available to borrow, it certainly has the raw ingredients of a stock under severe shorting pressure. Add to that no recent dilution risk and a very recent reverse stock split, which can sometimes precede increased volatility in microcaps. While recent price action has been downwards, the underlying barometrics are extremely bullish for a potential short squeeze scenario. Remember to do your own thorough due diligence. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth stock analysis, and let us know in the comments what stocks you want us to cover next. Thanks for watching, and we'll see you in the next video.